Lehman Brothers didn't just go broke, it walked into the largest bankruptcy in U.S. history, with a 31-to-1 leverage bet on housing that could be wiped out by just a 3% drop in asset values, according to Wikipedia. In September 2008, a 164-year-old institution that had survived the Civil War, 2 world wars, and the Great Depression vanished in a single weekend. According to Harvard's case overview by Wiggins, Piontek, and Metric, Lehman Brothers was the 4th largest U.S. investment bank when it sought Chapter 11 protection on September 15, 2008. That filing became, as Wikipedia notes, the largest bankruptcy in U.S. history, involving more than $600 billion in assets. Lehman didn't start as a Wall Street titan. According to background cited by Wiggins, Piontek, and Metric, it began in 1844 as a small dry goods store in Montgomery, Alabama, founded by Henry, Emanuel, and Mayer Lehman. Over decades, the firm evolved into a commodities broker, then a full-fledged investment bank. By the 2000s, under longtime CEO Richard Fuld, Lehman had mastered a specific formula. Wiggins and co-authors describe a high-leverage, high-risk business model that required Lehman to raise billions of dollars every day just to fund its operations. In the housing boom years, that model looked brilliant. According to the Harvard overview, Lehman pursued aggressive growth and was very successful. When you borrow a lot at low rates and invest in assets that are rising in price, your returns on equity explode. But there was a catch built into the math. The same leverage that multiplies gains also multiplies losses, and Lehman was about to test how far it could stretch that rubber band. To understand why Lehman loaded up on subprime mortgages, you have to rewind a few years. According to background summarized by Wiggins, Piontek, and Metric, the Federal Reserve began cutting interest rates in 2000, taking the federal funds rate from 6.5% down to about 1% by June 2003. Cheap money flowed into the housing market. Home prices climbed, and more people, including subprime borrowers with weak or no credit histories, took on mortgages. Banks and Wall Street firms didn't just keep these loans. As the Lehman case materials explain, they packaged mortgages into securities and sold slices of that income stream to investors. Lehman was in the middle of this securitization machine. According to Wikipedia's article on the bankruptcy, Lehman borrowed significant amounts to fund its investing, a classic leveraging strategy. A large portion of these investments were housing-related assets. In theory, the playbook was simple. Borrow short-term at low interest rates. Use that money to load up on mortgage-related securities. Collect fees and interest as long as homeowners kept paying. It worked beautifully, as long as home prices kept rising and credit kept flowing. Wiggins, Piontek, and Metric note that this high-leverage strategy delivered very strong profits for Lehman during the boom years. Inside the firm, risk models and daily monitoring by accountants and risk professionals, described in the Harvard overview, appeared to validate the strategy. On paper, the numbers looked controlled, but outside, something fundamental was shifting. Housing prices were starting to stall, and the quality of many of those subprime loans was worse than it looked in spreadsheets. The real danger wasn't just that Lehman liked mortgages, it was how much it magnified that bet. Wikipedia's bankruptcy article explains that Lehman's leverage ratio, assets divided by owner's equity, rose from about 24-to-1 in 2003 to 31-to-1 by 2007. That means for every dollar of its own capital, Lehman controlled $31 in assets, most of it funded with borrowed money. Here's why that's terrifying. According to the same source, at 31-to-1 leverage, just a 3-to-4% decline in the value of Lehman's assets could completely wipe out the firm's book equity. So, if you imagine Lehman's balance sheet as a 31-story tower, its actual shareholder capital was only the bottom floor. Knock 3-4% off the total height, and the owner's piece effectively disappears. This level of risk-taking was allowed in part because of who Lehman was. As Wikipedia notes, investment banks like Lehman were not subject to the same strict risk regulations that applied to deposit-taking banks. Without the same capital safeguards, they could push leverage much further. According to Harvard's Wiggins and co-authors, under CEO Richard Fuld, Lehman deliberately ran this kind of high-leverage, high-risk business model. It demanded constant short-term funding and left very little cushion if asset prices went the wrong way. For years, this didn't seem to matter. Markets were rising, housing felt safe. The extra profits from leverage made executives look smart and shareholders happy. But if your entire fortune depends on nothing bad ever happening, you don't have a strategy. You have a prayer. The housing party ended in 2007. According to the background cited by Wiggins, Piontek, and Metric, housing prices began to fall, and many homeowners suddenly owed more on their mortgages than their homes were worth. Subprime borrowers, who had been able to get loans during the boom, started defaulting. The securities built on top of those mortgages also started bleeding value. Wikipedia explains that Lehman's 2008 losses came from holding large positions in subprime and other lower-rated mortgage tranches that it had created in the securitization process. Why did Lehman still own so much of the riskiest stuff? Wikipedia notes, it's unclear whether Lehman held on to those lower-rated bonds because it couldn't sell them, or because it consciously chose to keep them. Either way, the result was the same: massive exposure to the worst part of the housing market. By 2007 and into 2008, those positions were imploding. Huge losses piled up in the lower-rated mortgage-backed securities throughout 2008, according to the same Wikipedia article. Lehman did try to back away from the fire. One summary of the period, citing Liudis as referenced alongside the Harvard work, notes that by mid-2008, Lehman had announced a $2.8 billion second-quarter loss on June 7, 2008, raised around $6 billion from investors to bolster its capital, reduced its gross assets by about $147 billion, cut its residential and commercial mortgage exposure by about 20%. Those moves were meant to boost confidence and reduce risk, and, according to that same summary, they increased Lehman's liquidity pool to roughly $45 billion. But the hole was too deep. As Baker Library's bankruptcy overview puts it, by fall 2008, Lehman was still over-leveraged in subprime mortgages, commercial mortgages, high-yield securities, and leveraged loans. The bets that had juiced profits on the way up were now dragging the firm under. By 2008, everyone could see Lehman was in trouble. The question was whether someone else would catch the falling knife. According to Wikipedia, Lehman was notified that credit rating agencies were preparing a downgrade because of its heavy positions in subprime mortgages. A downgrade would make its daily borrowing even harder and more expensive, threatening the funding that its high-leverage model depended on. Regulators scrambled. The same Wikipedia article notes that as early as April 2008, officials had unofficially approached Barclays executive Robert Diamond about acquiring Lehman. Around this time, U.S. Treasury Secretary Henry Paulson told CEO Richard Fuld that there would be no government bailout of Lehman, according to Wikipedia. Meanwhile, other lifelines were explored. Baker Library's summary explains that Fuld tried to secure a rescue deal with Korea Development Bank, Barclays, or Bank of America, but none of those efforts succeeded. This stands in sharp contrast to what had just happened with another investment bank. Baker Library points out that in March 2008, the Federal Reserve Bank of New York extended a $30 billion emergency loan to J.P. Morgan Chase so it could buy Bear Stearns. But for Lehman, regulators drew the line. The Fed refused to extend similar additional credit, according to Baker Library. As the crisis peaked, the Federal Reserve convened other big banks in an emergency weekend summit to see if anyone would finance a Lehman reorganization. Wikipedia reports that those negotiations failed. On Monday, September 15, 2008, with no buyer, no backstop, and no way to fund its mountain of assets, Lehman Brothers filed for Chapter 11 bankruptcy protection. Wiggins, Piontek, and Metric emphasized that this was the largest corporate bankruptcy in U.S. history, with assets of about $639 billion and liabilities of roughly $613 billion. The collapse sent shockwaves through financial markets globally and became, as Wikipedia describes it, the climax of the subprime mortgage crisis, what some called the Lehman shock. It's tempting to file Lehman's story under Wall Street problems and move on. But the logic that destroyed Lehman shows up in personal finances all the time. According to Wikipedia, Lehman's leverage ratio went from about 24:1 to 31:1 in just 4 years. That meant a 3 to 4% decline in asset values could erase its equity. Many individuals repeat this same pattern in mini form. Taking on a giant mortgage with almost no down payment because home prices always go up. Stacking investment loans or margin debt on top of an already risk-heavy portfolio. Assuming that because low interest rates made borrowing feel safe last year, they'll stay that way forever. Lehman's management, described by Wiggins, Piontek, and Metric as operating a high-leverage, high-risk model, had plenty of sophisticated risk tools. They still underestimated how quickly conditions could change and how little room for error they really had. The core lesson isn't that leverage is always bad. It's that if a small, plausible shock can wipe you out, your leverage is too high. For an individual, that might mean stress testing your finances. If your home price dropped 20%, or your investments declined 30%, or your income fell for a year, could you stay afloat? Keeping a real equity cushion. More of your assets funded with your own capital, not borrowed money. Treating periods of easy money and rising prices as dangerous, not safe. Because that's when overconfidence and overleverage quietly build. Lehman's 31:1 bet is a reminder. You don't need a once-in-a-century crash to get wiped out. You just need a little bad luck when you've left yourself no margin for error. Lehman Brothers shows that leverage isn't just a tool. It's a ticking clock. When a small, predictable shock can wipe you out, you're not investing. You're gambling with no margin for error. Look at your own balance sheet like a risk manager, not a gambler. How much of your life is funded by debt, and how small a shock would it take to knock it over? If you want more deep dives on how big money wins and loses, and how to keep your own leverage under control, hit subscribe and stick around for the next Net Worth Autopsy.